are talking about earnings and the newsmakers, let's take it across to Mr. Umesh Revankar. He's joining us. Of course, he's the Executive Vice Chairman at Shriram Finance. Mr. Revankar, good afternoon. Good to be speaking with you. I just wanted to directly get into the details of the deal that you have announced for the housing finance company with the sale coming into Warbug. First up, the concern on the street is a bit that you have priced it a little too attractively for Warbug to pick it up. What's your take on that in terms of the valuations? Because if you look at the price to book, it's clearly at a bit of a discount versus the listed peers.
Yeah, good afternoon. See, every deal is different and every transactions are different. No two deal can be compared. In this particular transaction, we had an option of taking a investor along or have a total sale, or we would have done a swap deal also. So if it is a swap deal, probably the pricing or valuation could have been much higher. And if we had taken a part investor, it also would have been higher. So here we wanted the management to feel very comfortable, leadership and management of Shriram Housing, so that they have a good promoter and also an investor who will come in with the growth capital. Now, this Warburg also has plan to invest around 1,000 crores post the deal as growth capital. And that's the comfort we need to, because when you are wanting to grow fast, and especially the company has been growing at 50% plus CAGR for last 4 years, and it has a long way to grow into larger company, we need to give that comfort. So we have the best investor who possible who have come in, and we are very happy with comfortable with the deal.
Mr. Revankar, very interestingly put that no two deals are actually equal, and if you want to structure the deal the way you like it, perhaps a little bit of leeway on valuation may be a great idea, especially when partners such as these are coming. I also understand that post this transaction, now the focus of Shriram actually comes on retail, which you have already spoke about a little bit earlier as well, and also focus on growing the SME part. What kind of focus are we talking about here? On growth, what kind of visibility can you offer to the to our viewers and your shareholders on the focus on these two segments particularly?
Yeah, the focus will be more on the SME segment. We feel that SME segment has huge potential to grow and reach, because SME, if you look at the what people call it as a credit gap, it is estimated that around 40 lakh crore credit gap is there in the SME sector. Especially, many of them are underbanked. Not that they are not banked at all. It's underbanked, and there's a need for a huge credit supply there. And therefore, we felt that we should focus on SME plus the even commercial vehicle and passenger vehicle, both are growing quite well. And we have 3,000 plus branch network now with post-merger. And we have a lot way to get into deeper pockets and grow our business. So we'll be focusing on the business, which is basically lending to the businessman, entrepreneurs, self-employed.
Clearly I understand that there's a very big credit gap, but at the same time, by the commentary coming in, from the regulator, it appears that the regulator is not very comfortable with 35-40% kind of growth levels as far as loans are concerned. Because even gold loans, for that matter, a large part of gold loans, I mean, the few instances which happened actually are by, self-employed to fund their business. SMEs too showing massive growth. Where would you like your SME book to, moderate at, or what kind of band would you like to grow it at, not to go in very scorching pace, but not to at least miss out on the big growth opportunity there?
Yeah, if you look at our last year growth, we grew our AUM by 21%, and the SME grew at around 27-28%. Two-wheelers grew at 27-28%. The passenger vehicle grew at around 27-28%. The range bound between 25 to 30% growth was there. CV grew at around 15%. So that is the growth rate we have in various verticals of the business. Basically, we are supplying to the people who need credit for growing their business. And this year, probably we'll be growing a little slower in certain segment, mainly because the first 2 months of this financial year will, because of election, there will be little slowdown in certain activities, which is dependent on government spending and also government machinery being involved in the election process. Even a simple thing like the vehicle hypothecation endorsement, these are getting delayed. So these are all things, I should say that would slow down a bit, but second half of the year should be really good because the monsoon prediction being good, and that is a very big positive. Rural economy doing well. Last year also did well, and this year also it is likely to do well. That's a very big positive, and we
Right.
should be able to grow at around 15% a year.
So 15% AUM in FY25, that's the target, with largely it being lag-ended, with the second half of the year being better. But you talked about the various segments, the growth rate that you had seen earlier, and now you're talking about in certain segments you're expected to moderate a bit. Throw more light on that. SME, commercial vehicle, passenger vehicle, what kind of growth rates are you expecting in each one of them, and even gold finance for that matter?
I see. We should be very comfortably growing anywhere between 12 to 20% in most of this vertical, and I expect a little slower to growth in the CV, mainly because of the infra spending being postponed, and because there will be another budget in the June when the new government comes in. So that will delay certain allocation, and therefore we expect the infra spend to be little delayed. And by the time June budget is over, the monsoon will be there. Therefore, the first half of the year will be little slower.
I also understand, Mr. Revankar, the Tier 1 capital will be, of course, boosted on account of this. How would it aid your capital adequacy ratio? What's the expectation of provisioning, etc., going forward?
The capital adequacy CRAR will be combined Tier 1 and Tier 2 put together will be 22% after this transaction. And we will be consuming something in this year. So maybe it will come down to around 21 or maybe less than 21. We are very comfortable till it becomes 18 or 19. And we can always go for raising further capital in the next year or so. We are not in a hurry after this deal. This helps us for our growth capital for next 1 or 2 years. And after that, we'll look at it. But as far as the provisioning and other things are concerned, I feel this asset quality is continuously improving in the last 2 years and is likely to improve further. So we are very conservatively have made the provisions, and asset quality being improving, we don't really need to provide more.
Mr. Revankar, I just want to go back to that point of second half which you made. Some of your peers, related business peers, not completely match, but at least I'm talking about CV financiers, other CV financiers in the southern region, the prominent ones, even CV OEMs. When we speak with them, one is getting a sense that the second half of the year is when the CV cycle may actually improve meaningfully. You've also been part of your businesses. I mean, you've been a major player there, and now with the combined book too, a reasonable portion comes from there. What is your sense on the CV cycle, when it is likely to turn, and once it turns, how prolonged or durable does it look like this time?
The CV cycle, if you look at in the last 2 years, it has been positive year on year. It's growing, and this year also it is likely to grow. And maybe my expectation is it will grow for at least 2 to 3 years on a new vehicle sales, and used vehicle demand on a lag. It should be for 3 to 4 years because there is always a lag after the new vehicle sales improves year on year on a used vehicle, mainly because the prices are gone up in the last 2 years. The increased prices have made the new entrants little difficult to come in, and therefore the existing owners have an advantage that their price have improved and the resale price have further improved. So this has one thing is there is no a sudden increase in sale. It has been gradual. And since it is a gradual, it is likely to play for a very long time. So I expect overall for used and new vehicle, 2 to 3 years or 2 to 4 years for used vehicle from now. And there will be a positive growth and maybe that will help all the lenders in commercial vehicle to keep growing their books.
Okay, gradual recovery is what you anticipate. Thank you, Mr. Revankar, for joining us today and helping us understand what exactly this deal means for the business and, more importantly, the fundamentals of the core business as well.
If you like this video, then like, share and subscribe to ET Now.